August edition of the PPOB meeting. Call this meeting to order. And Madam Clerk, if you would, please call the roll.
Senator Byrd, Senator Carroll, Senator McDaniel, Senator Mills,
Here.
Senator Neal, Senator Nemus,
Present.
Senator Wilson,
Here.
Representative Bojanowski, Representative Duval,
Here.
Representative Fleming, Representative Graham,
Here.
Representative Petrie,
Here.
Representative Pratt,
Here.
Representative Tipton,
Here.
Auditor Ball.
Matt Fry's proxy.
Thank you. John Hicks, Victor Maddox, Sharon Mattingly, Representative Hale, Senator Higdon,
Here.
Representative Johnson.
Here.
We do have a quorum. And need to have approval of the minutes. Have a motion for approval of amendments for our last meeting.
So moved.
We have a motion, second. We have a motion and a second. All in favor signify by saying aye.
Aye.
Any opposed? Motion carries. The minutes are approved. Okay, first article of business today looks like the Judicial Form Retirement System. Bo, if you will, state your name for the record, and the floor is yours.
Well, good afternoon. Turn the sound off here.
Kind of sounds like you're on a PA system on a football field.
Yeah. I've turned the speaker off, but
Yeah, the microphone down here on this one's muted. Is the one on yours muted? I'm not really sure what's picking up that echo there.
okay. Yeah, it's weird.
The IT guy left, didn't he?
Yeah. We'll give it a shot.
Yeah, I'm not sure what it is. We might have to call back.
Well, for the record, my name is Bo Craycraft. I'm the Executive Director of Judicial Form Retirement System. It's good to be here today. I've been asked to provide a quick update on investment performance as well as asset allocation and cash flow. So getting right to that, slide 2 is a summary of recent performance to the end of the fiscal year. Again, that's end of month June 30, 2024. Despite what, several folks in the investment world had concerns about the fiscal year and the beginning of 2024, but as you all know, equity or markets have continued to provide very strong results, specifically within U.S. markets. As we've discussed here on several occasions, the board at Judicial Forum has taken what we call a aggressively conservative approach to investing plan assets. It's aggressive in the sense that we invest a significant allocation in U.S. equity, which is one of the more volatile asset classes when you measure by standard deviation and those type of risk metrics. But on the opposite side, they're fairly conservative in that it's all U.S. based and they do not participate in any what we would call more exotic or untraditional asset classes. At a very high level, the board is operating on a strategy that they believe that U.S. markets over a longer term period, 10 to 20 years, are going to win, that they're going to outperform other global markets. That's built off a belief that, if the U.S. economy is going to continue to grow and the U.S. is going to continue to be a world leader, then the underlying companies that operate in the U.S. also have to succeed. And so while our plans do have some cash flow needs, and we're going to talk about that in a minute, they've been able to manage that. It's been at a manageable level. And so what that has allowed our board and our sole investment manager to do is they've been able to weather those periods when the U.S. markets haven't outperformed. And not only have they been able to weather, in many cases, they've been able to add to existing holdings and then reap the benefits when equity markets have come roaring back, as we've seen, for instance, over the last 2 years. We experienced negative returns in fiscal year 22, but 23 and 24 have both been very strong. Now, that's a pretty long-winded effort to really say that when U.S. equity markets do well, you should expect our plans to do well as well. And when you look at the 1 year period ending June 30, that is definitely the case. The S&P 500 was up just over 25% for the 12-month period ending June 30. And with 70+% of our assets in that asset class, we too perform very well across the board. And you can see from 1 year returns that were 19.5% to 20%, depending on the plan. Across longer term time frames, the plan has continued to provide solid results. 9% for the longest term trailing 30-year period, and then 12.5% for the last 5-year trailing period, which I know is always a time frame we keep our eyes on, given the fact that we smooth returns or gains and losses actuarially.
Okay, I need to stop sharing for a second.
Okay, you're fine.
I'm just going to do the whole thing.
Okay.
All right.
All right. How do I go backwards here?
Use the arrow key.
There we go. So yeah, over the 5-year period, 12.5 to 11.5%, depending on the plan. And so, personally, as a fairly conservative, worst case scenario type investor, it's hard for me to see a future where I don't show up here in sometime in the near future with some bad news. It's not always going to be rosy and 20% returns, but for the purpose of this fiscal year, I am quite happy to report that for the fiscal year 24, we had another very successful year, exceeded our assumed rate of return, and we're able to add some gains, which we're going to see reflected in a minute, actually helped us also gain assets as a plan. Slide 2 is just a quick snapshot of asset allocation through the end of the fiscal year. Just as I mentioned, 2 primary asset classes, S&P 500, large cap U.S. equity, targeted at a 70% allocation. Then we also have a 30% allocation to intermediate government credit bonds. I've been more on the corporate side here recently, just given rates, but more recently we've added a few U.S. Treasuries. Baird, who is our Baird Trust out of Louisville, Kentucky, who is our sole investment provider, does have the discretion, plus or minus 10% with regards to those targets. We've talked about it the last couple of quarters, actually. They have been sticking pretty close to the targets. I think they view, equity markets as, primed to maybe have a little of a drawdown, but also with rates, fixed income has begun to provide some level of return, so it's made a little more sense to hold those bonds. Also, we've talked the last couple of quarters. We are holding a little bit more cash than you would have probably seen us hold, 15 to 18 months ago. That's for a couple of reasons. One, to meet benefit payments. Our payroll, has continued to increase over time, and the amount of employer and employee contributions have not significantly grown. And then secondly, again, with the rates higher, cash has now started to provide some level of return, whereas 15 to 18 months it was really negative or zero. With that, slide 4 is a snapshot of cash flow. Just a couple of things to point out. As we've discussed and as I mentioned earlier, given the plan's funding levels and the suggested employer contributions, there's been no contributions on the legislative retirement plan. In this 2-year period, we did have some minimal contributions on JRP. Fiscal year 25 also had a very small contribution, just under $600,000. So employer contributions have gone almost to zero. So we're going to have some negative cash flow. So when you look at that gray shaded area, negative cash flow has increased slightly, but when you look at the net cash flow ratio that's calculated just underneath there, all close to that 2%, which I know this committee has heard testimony from anywhere like 3 to 5% is generally deemed manageable. So we're in a manageable range there. The other two things I will just note really quickly, we talked about these in April. Member contributions did decline a little bit, which seems counterintuitive since salaries are increasing. That's really due to kind of a one-time event related around a large number of service purchases that we had right towards the end of the calendar year 22, where we had several members retiring. And they did some service transfers or purchases right before leaving. So we had a lot of one-time contributions there. And then secondly, you see investment income also declined a bit. That's also related to a one-time event. It's related to GE. General Electric has spun off into 3 different into 3 different companies. One is an energy-based GE Vernova, which we continue to hold. There was also a spinoff of a healthcare their healthcare arm, which we do not hold, but when we received that, it was booked as like a non-cash income activity, kind of like a dividend in the form of stock instead of cash. So that made the investment income look like it's declined. Other than that, lastly, just again, note that even with the negative cash flow, given the considerable unrealized gain and losses that were resulted from the investment returns, you can see that net year over year, the assets did grow, but that's all driven by investment results. With that, I didn't have anything else prepared. Happy to try to answer any questions you have. Again, appreciate the opportunity to present.
Thank you, Bowen. Very good report. Like I said, we'll probably have some in the future not so good, but it's always great to get good news.
Absolutely.
Can you tell us a little bit about the down the road, the increases in our, I guess, retiree insurance costs due to the Inflation Reduction Act? Can you give us a little insight into that?
I can try. I am not a health insurance expert. In fact, I tell many of a retiree that the worst part of my job is health insurance. It's confusing, and I've got a lot of education. But specifically, I think what you're speaking to is with regards to the Medicare over 65 population. There are some significant kind of changes that are occurring in that space. Most specifically with regards to what you often hear referred to as Part D prescription drug plans. So Medicare is kind of comprised of 4 primary parts that we speak of. Part A is hospital coverage. It doesn't cost anything, and from what I gather, you get what you pay for. Part B is what we can call medical. That comes at a cost to the individual that's charged through Social Security. And then Part C is what is called like a supplement to the medical. Supplements Part B. That's we provide a Part C plan. I know the other plans as well, teachers and KPPA also. And then our Medicare Advantage plan also comes with Part D, which is the prescription drug portion of Medicare. The Inflation Reduction Act has been incorporating changes. Some started in this current calendar year. They're going to continue to occur through the 26th calendar year, but most specifically and most dramatically is there's some significant changes occurring January 1, 2025 on the RX side. I'm going to oversimplify this, and the folks from KPPA have a lot more expertise here, so they might be able to add more value than me. But on the prescription drug side, there's been kind of a max out-of-pocket cap that has historically been $8,000, and that number is changing to $2,000. So it's going from $8,000 to 2,000. And so somebody's picking up that difference, and it's not the drug companies and it's not the government, it's the plan sponsors largely. So as a plan sponsor of a plan, that means our premiums are going to significantly increase. And so we're currently, the board just reviewed some proposals from Humana. We're looking, anywhere from 35 to 50% increases on premiums with no change in plan design. And of course, the board does have some option to change some plan design, but again, we're talking mostly on the drug side, and so there aren't a ton of options there outside of increasing copays and those type of things. But increasing a copay from $5 to $10 on a drug that costs $100, if you're, it's a $5 difference. If you were used to paying $60 and now you're paying $100, you can only capture so much of that increase, and so significant. We're trying to communicate, and as you all will probably get feedback too. The underlying policyholder, it's a net benefit increase, right? The max out of pocket is being reduced. And unfortunately for us, it means our premium is going up. And so it will cost the health insurance plans more. And we would expect to see some deterioration, on the actuarial side, which is a good point for me to say. I meant to kind of inform the board that we also have changed actuaries. We had been with a group called USI, which was really the result of a couple mergers. We used to have a kind of a more regional actuary, and they'd been bought and sold a couple of times. The board back in April actually selected Gabriel Roeder Smith, which I know a lot of you all are familiar with for their work at KPPA. And so we have the exact same team that works with KPPA, so they're very familiar with not only our plans, but also you all and our General Assembly and what you all have done on the retirement side. And so we're excited to have them join us, and it's something that we've already asked them to incorporate in the GASB updates that we should be getting here in a couple of months.
Okay, thank you, Bo. Any other questions? Looks like you got off being truthful and right up front with us, especially about that Medicare Part A. Thank you. Next up is KPPA. Ryan? Ryan, welcome to your first PPOB meeting. Hopefully you leave here with weighing as much as you did when you came in. We're not.
Well, thank you very much. Actually, it's not my first. The last time I was here is 2015 when I testified here. So it's been a minute. Very much appreciate that. And Aaron's going to address that previous question, but just kind of to start from that 2015.
Well, let me
Yes, sir.
interrupt you just a little bit. Do tell us a little bit about yourself. It's been a few days since 2015, and give us an update, and
Yes, sir.
and then the floor is yours.
Yes, sir. Just a little bit of the background. Worked in the private sector, broker-dealer for quite a while, so the investment discussions are not new to me. Decided to start my public service. City of Lexington, was the budget director there. I loved it. Really enjoyed it. I saw the mayor was here just recently. Enjoyed watching that on her testimony to housing. Decided to come to the state a dozen years ago. Office of Financial Management, very similar to what we do in investments. Of course, larger amounts at KPPA, different asset classes. But the credit side was one that paid attention to both legislative, judicial, TRS. That was something that we watched in the Office of Financial Management. So credit rating agencies and cash management and all the debt for state agencies, universities was kind of in my purview. Didn't think I would ever leave. Thought I would retire there at OFM, but really found a home at KPPA. I've enjoyed it thus far. People are happy to work there. They've been there a long time. And I've said to many people, there's a lot of food. There's a lot of food in the agency. So for events like that. And just to close that out, thank you for letting me say that. I guess the improvement that PPOB has made over the years is not gone unnoticed. People like me that paid attention to it every day, investors would ask questions, rating agencies would ask questions. It was contentious in the beginning when I was charged with managing those relationships. The connotation, the tone was not positive. It's changed. I've told everybody that I've met with individually, I'll tell you collectively, thank you, thank you, thank you for the supplemental funding. That's moved the needle. Regardless of what people think about the changes, it has put members in a better financial situation. So thank you for that. I'm happy to go through the slides, between the two bows. We're here talking about the same three topics, but if I may just go to the previous question, I think just while it's fresh in the mind on the recent changes at the federal level, from my perspective is headline is it's better for the member, but there's a cost to it to the pension funds.
Aaron, for the record, introduce yourself and the floor is yours.
Thanks. My name is Erin Surratt, and I am the Executive Director of the Office of Benefits at KPPA. I think Bo did a really good job explaining some of the changes that are coming in with the IRA. The one thing that I would add is that the $2,000, the cap there, that is not an actual out-of-pocket amount for the retiree or beneficiary. It's an incurred cost. So Humana has showed us a scenario where a member could pay a $50 copay and still hit that $2,000 out of pocket. So there were also some adjustments to the coverage gap, known as the catastrophic phase, where the plans will be responsible for a much higher share percentage of those costs, whereas before the government, once they hit that catastrophic phase, the government was paying 80%. The plans will now pay 60%, and the government will pay 20%. So that's the only additions that I have to say. I will say that our premium, much like Bo's at JFRS, is going up, it looks like, about 55% from where it was last year. We do have a retiree health plan committee on Tuesday, next Tuesday at 10 o'clock. So there'll be a lot of information, and Humana will be there to present a lot more detail about some of these changes and the change to the premium amount. And those are broadcast live on Facebook.
And I'm sure there's some concerns about that type of increase. Have you done any, what is that going to cost the plan?
Yes, and I'm sorry, I don't have the dollar numbers in front of me. We will have that also in the materials that I can send over, but they'll be presented at the meeting on Tuesday. But we're looking at maybe somewhere preliminary a 5 to 10% decrease in funding in the health insurance trust. So due to that increase in premium.
Okay, thank you.
Thank you.
Yeah, just to round that out, it really does speak to the volatility and the funding status on the insurance side. It's a big driver where we have a lot of actuarial assumptions on the other side of the house. So, but again, highlights are the members are going to have better coverage, but there's a cost to it.
Okay, please proceed.
Yes, sir. So we were here for the same three topics: investment returns, asset allocation, and cash flow. Obviously, we have multiple plans, so kind of want to start with a highlight. The most important thing to me is performance to actuarial assumptions. All plans exceeded it, so that's going to be a benefit when the actuaries do their next analysis. In the 3 to 5 year range, top decile, top 10%, and Sharpe ratio, which is just a mathematical formula adjusted for risk related to performance. And the policy performance benchmarks, 17 of the 20 measures, over the longer term, 5 years and out. And the biggest driver for investment returns is really your asset allocation, and our boards control that. Both of those have made recent action. The K in February did a rebalance, and the C side did the allocation targets. And I will say there is one nuance when we talk about asset allocations. This is as of 6/30. Well, there's new asset allocations that were implemented 7/1, so that sheet may look a little strange because we wanted to report as 6/30, which was the ask of Brad. So that's the way we reported, but that nuance is out there in terms of the red that you see on there. So in terms of return, the way I always look at this is like a broker dealer. I look at right to left, the kind of discount rate or your target that your actuarial assumptions are made on. We've exceeded that for the period of 5 years and out in terms of that return. So better actuarial performance than what we report. It's been off the benchmark in fiscal year date, which is really just the fiscal year and the 3-year mark. Really two reasons for that. We, by investment policy, have diversity in our asset allocation. And when you have things that enter the market like AI and other technology companies that really spur the market, and Bo said this, and I think the next Bo will say the same thing. The equity markets have done really well, but it's been concentrated in a certain amount of firms. So there's essentially 7 firms that really drove, if you break it down, Steve, CIO's on the line, he has the number, but really those 7 firms really drove like almost 70% of the growth. And if you're forced, which I think rightfully so, for diversity to mitigate risk, you can't get the upside in terms of that concentration of those small amount of names. The other thing is our benchmark, and the boards are working on this, but in the private equity space, so the not traded component of equity, our benchmark is really just what does private equity do plus 300 basis points. That's not necessarily representative of private equity, how that asset class does, but that's the benchmark that is currently used. And our investment team and the boards are working on that to maybe have more representative benchmark that you see under performance. But what my eye catches is almost 10% return on across all the plans. So strong equity, strong returns, exceeded the benchmarks, but those two nuances in terms of 3 years in. Same story on the investments, on the insurance side. 5 years and out really exceeded. A little stronger performance in the 1 year in terms of most recent, but similar performance that we saw on the pension side. Strong returns kind of across all the different plans. This is the asset allocation. So asset allocation drives primarily what we just saw. I think Dave, when he testified last time, there was 14 red up here. And as the boards kind of redo that asset allocation, the C and the K, we've come back into line. There was changes that were recently made. But in 7/1, the targets changed. The board's still working on the C side in terms of the range. But I think, if we do this presentation soon, you don't want to make major changes in your asset allocation. You don't want to just liquidate a position and move it over here. There's drawdowns, there's capital calls. So this is kind of a plan to migrate to the new ranges that the board set, right, which really drives returns. So moving to the cash flow side. We will start with the K, non-has, and has, and state police. Kind of where I start is really your ending net position, but backing up from that is kind of the old actuarial formula. You have contributions coming in, you have investment returns. The other side of the equation is you pay out money, and you have fees associated with that. Really, that's the 4 things that my eye catches on this. So in terms of the outflows, we have higher outflows, right? So inflation's been prevalent in the market. Those that retire presumably at a higher amount. So we have higher outflows. inflows would have the same thing in terms of, increased salaries. You'd have additional money coming in. Employer contributions would increase. General fund appropriations, again, thank you very much for those. Much appreciated. That's on the screen, and then those that are in the budget for 25 and 26. And then we have an increase in net position through the 2Ks in the state police, which is what we would want to see. And then, I know a lot of times people focus on that like cash flow number, but it's really going to be different based on your funding status. So if you're a fully funded plan with 100% of your assets in the trust, you're going to have a lot of interest earnings. So in that formula I talked about, you're going to have higher interest. For a less funded plan, which we all know is K has, that $240 million supplemental in both of the fiscal years, they mean a lot. And that's really what changes the net position for those three trusts. I guess moving over to the C side, the non-hazardous and hazardous, I think it's kind of the same story. You have some additional member contributions. Again, I think that's related to inflation that have driven wage assessments a little bit higher across the state. Investment income it is up as well because we've had, again, strong returns over the period. We have a positive net flows, but then when you back out the investment income, and this kind of makes sense, for the Cs that are a little higher percent funded, you do have kind of net flows without investment income. You do show some negatives there. Again, not a concern. I think within a range, it's reasonable. And they're better funded, so maybe apples and oranges between the two plans. And you'll see this in the insurance side that are clearly better funded on that cash flow number. So again, switching from the pension side to the insurance side, we see the employer contributions for the non-hazardous is up, the state police, and you'll see the percent that's funded in the hazardous kind of in a below line. Not necessarily, we can talk about the House Bill 1, but how we report that. But the net investment income, as I said, driven by strong performance above the discount rate. We have the total outflows, and net inflows kind of overall are improved. You do see some reds here. I'm not a person that likes to read the numbers specifically, but you have a K hazardous that is overfunded. Again, it's changed based on what Aaron just said. But as of this reporting date, you do have those negative cash flows kind of pre and post that interest earnings. But again, not a concern. Because you do have those assets, whereas some of the other plans don't necessarily have as many assets that generate that I in that equation that I just talked about. In state police, similar kind of basically breaks even, and then if you back out the net cash flows without investment income, which is in the bottom box, looks like gray. I'm not great with colors, but you would see a negative there. But again, I don't necessarily view that as a problem. And then on the insurance side, flipping over to the C, we have some additional line items. I didn't mention those before, but the Humana Gain Share. And I really look at that contribution line all collectively. That's inflows in that equation. And both of these are, again, based on last actuarial study, above 100%. It's going to change based on what we just talked about, but it's representative in the cash flow. Both net position has improved throughout both the 23 and 24 period that we're reporting on today. So I'm happy to drill down in the numbers, but I'm not maybe one that reads them to you. Any questions or?
Let me ask you about the negative cash flow.
Yes, sir.
We have negative cash flow, and I guess my concern is, my comment, have negative cash flow, and this year we reduced our contribution rates. And that's just a comment. I don't know. The board's decided to do that, to take those reductions. But anyway, that's just a comment that I have. It's kind of, to me, it's not good when you reduce your rates and you have a negative cash flow.
Yes, sir. So just my understanding is the K's rate didn't necessarily, I mean, there's complications in how we have the actuarial liability, but it was just the C side of the house. Yeah, that did.
That's where the negative cash flow
Yes, sir.
is.
Yes, they did have a reduction in rates. Salaries went up kind of across the board, which is what we think will pan out in the actuarial study. We think that's true. Within a certain range, I don't necessarily have a major concern. So, if you back out investment income on the pension side, clearly negative. But if you include the coupon payments and the disbursements in the income line, it would be positive.
I just had to ask about negative cash flows. That's always something that
Yes, sir.
I'm concerned about. So thank
Yes, sir.
you. Representative Tipton has a question.
Thank you, Mr. Chair. Appreciate you being here today. One question or one comment first. Since I've been on this board, been in the General Assembly, we've seen a disturbing trend in regard to retirements about the number of employees compared to the number of retirees.
Mm-hmm.
It's really been inverse of what it needs to be to have a sound, functional pension system. As I'm looking at the contributions from employees, from employers, we know we have had some salary increases the last few years. What are the numbers telling you about? Is this increase amount, is it coming from the salary increases, or are we seeing more employees compared to the trend over the last 10 years in state government and county government?
Yeah, that one.
Yeah. I don't have a definitive answer, but I do think that we have seen some increase in the number of employees. I don't know by how much. I'm sorry, I don't have that information, but certainly the salary increases and a slight increase maybe in some employees.
Mm. And just directly, some have told us, with the salary increases, they're going to stay around longer. But that's just anecdotal. So
If we could get some updated numbers, comparison numbers over the last few years, that might be helpful.
Sure.
Just to see us where that trend is going.
Mm-hmm.
Thank you.
Yeah.
Seeing no further questions. Do you have any further comments?
No, thank you very much.
Well, that wasn't all bad, was it?
No, sir. Appreciate it.
Thank you.
Thank you all. Next up, Kentucky Teachers Retirement System.
Okay, you got it.
Bo Barnes and Gary Harbin. Welcome, gentlemen. Appreciate you being here today. Neither one of you need any introduction, but if you would introduce yourself for the record, and the floor is yours.
I'm Executive Secretary of Teachers Retirement System, and I thank you all for inviting me down today. So,
Well, we thank you for being here.
yes.
Good afternoon, Bo Barnes, Deputy Executive Secretary and General Counsel for Teachers Retirement System. Good afternoon. We've been asked to make a similar presentation today about investment returns, cash flow, and asset allocations. And with that, we will begin. The first slide here is the investment performance for the Retirement Annuity Trust for the quarter ending, or for the period ending June 30th, 2024. These are preliminary and unaudited returns. I'll note that, but they should not change significantly. For this afternoon, I'm going to be concentrating on the bottom two rows of this slide, beginning with the very bottom one first. You'll see for the quarter ended June 30th, 2024, for that 3-month period, there were net returns of 0.88%, which placed TRS in the top 55% in the country compared to other large public pension plans. For the 1-year period, the returns were 11.93%. which placed TRS in the top 10% in the nation. I will note that 11.93% marks the second consecutive year of double-digit returns for the Retirement Annuity Trust. For the 3-year period, we had returns of 3.22%. Remember, we had one really bad year in that 3 years, and that's why it's 3.22%, and that will roll off shortly. But that places in the top 41% in the nation. For the 5-year period, 8.5% return, top 12% in the nation. For the 10-year period, 7.66% return, top 8% in the nation. For the 20-year return, 7.42%, and we don't have a comparative information for the 20-year period. As I always note, TRS is a long-term investor. We have a long-term horizon, and our 30-year compounded gross return was 8.1%. Our assumed rate of return for the Retirement Annuity Trust is 7.1%. Moving on to the next slide, same information largely for the Health Insurance Trust for the same period of time. For the quarter, for that 3-month period ending June 30th, 2024, returns of 1.59%. For the 1-year period, 12.4%. 3-year period, 4.24%. 5-year period, 8.74%. 10-year period, 7.1%. A health insurance trust has the same assumed rate of return as a retirement annuity trust of 7.1%. Moving on, this is our cash flow slide, which I know this body is very familiar with. It's the same one we use for every cash flow presentation. And as always, I'll note this slide is really, you can divide it in thirds. The top third, which is cash inflows, the middle third, which is cash outflows, and the bottom third, which really summarizes the results of those cash inflows and cash outflows. I will begin with, and these are preliminary and then audited, I'll note that. But I will begin with the column, the second from the right, that reflects the period ending, fiscal year period ending June 30th, 2024, that 1-year period. And just to the right of it is for the period fiscal year ending June 30th, 2023, the previous fiscal year, just for comparison purposes. So you will see that for fiscal year 24, member contributions for $383 million compared to in 2024, compared to $366 million in 2023. Employer contributions were $1.176 billion for 2024 compared to $1.144 billion for 2023. Investment income, that's really just stock dividends and fixed income interest, $419 million for 2024 versus $382 million for 2023. Total cash outflows, you'll see for 2024, $1.978 billion. And for 2023, $1.893 billion. The middle of the third of this slide shows the cash outflows, as I stated, and that's largely, of course, as you'd expect, benefit payments and refunds when members refund their accounts. But this is mostly benefits being paid out the door throughout Kentucky, mostly throughout Kentucky. $2.499 billion in 2024 versus $2.418 billion in 2023. Administrative expense is a smaller amount. You see it was just over $15 million in 24 compared to $14.5 million in 23. Primarily, where the drivers of the increase would be a 6% across the board statewide increase for state employees for the year. And then also we have some IT expense with some things we're doing with our IT system. So total outflows for 24 were $2.515 billion, and for 23, $2.432 billion. So when you look at just those cash inflows, the member and employer contributions and investment income, and compare those to cash outflows, mostly those benefit payments, you see there is a negative cash flow for 2024 of $536,500,000 compared to slightly less than the previous year when it was $538,900,000. And as we've discussed, two things here. One, with mature pension plans, it's normal to have some negative cash flow. It can become a problem when the negative cash flow becomes too large. And before we got the additional funding that we are going to talk about in a minute, for which we're very grateful for, before we got that additional funding, our actuary had concerns because we were seeing negative cash flow go up every year, and it was getting to a dangerous level. But what you see before you today, it's just over 2% negative cash flow. And you heard Bo Craycraft talk about earlier about presentations to this board that 3 to 5%, is an acceptable range. So we're below that. And then we always talk about the rest of the story because the top third with cash inflows doesn't tell you a very important part of the story about how the assets grow at TRS. And those are investment gains that are realized or unrealized. Realized, we're selling stocks and getting money from that. Unrealized, we're seeing the market value of the total or the portfolio grow. And you see for 2024, those gains, we had gains of $2.381 billion. More than we had in the previous year, which we had good gains in the previous year in 2023 of $1.883 billion. So I'm just going to focus now to give you the summary of what all that means, and that is on the second column from the right, those bottom two numbers. You see the top of those two numbers, $24,244,600,000. That was the market value of TRS assets in the retirement annuity trust for June 30th, 2023. Go to the line before that. You can see that over the year, the assets grew by about $1.8 billion to $26,088,900,000. Good year. It was a very good year. Next, I'm going to turn to the cash flow of the health insurance trust. This is exact same.
Oh, could I interrupt you?
Yes, sir.
Before we
Chairman
leave
Johnson
that slide.
has a question.
Thank you, Mr. Chairman. So looking at the cash flows, I just want to kind of get a picture here. And I know you're going to talk about the extra money that has been put into the funds recently. Here's my question. As much as we would love to be able to dump a bunch of extra money every budget on top of the funds, it's probably not realistic. We have negative cash flows without that funding. Does that raise a red flag? And if it does, what do you suggest? What's going to have to happen to change that trend?
With the negative cash flow?
Yeah.
Well, and again, the additional funding has had us consistently on a path and now sort of a stabilized location where negative cash flow has been fairly consistent and in low ranges. And we talked to our actuary about this. They will say the same thing that Bo Craycraft said earlier, is that 3 to 5% is acceptable. Within a range. 5 you start to worry a little bit, but if you're under that at 2%, not only is a 2% negative cash flow percentage acceptable, it is expected with a mature retirement plan. You're going to have some negative cash flow. But you'll still see the value of that portfolio increase even with negative cash flow because the analysis of negative cash flow doesn't include those realized and unrealized gains.
And these are great numbers now. I'm just looking 6 years from now when what we're putting in as extra money becomes the actuarial required amount. And there is no extra money. Is the cash flow going to be a bigger problem in 6 years than it is now, or is there something that's going to soften that trend?
No, I would anticipate that cash flow will remain very similar to where it is now. And we have the assumed rate of return that I noted earlier of 7.1%. And on that previous slide, 30-year period, we're beating that by a full percentage point. And it is a long-term number. It's not a quarter number. It's not a yearly number. We're looking at long-term. So we have a very conservative 7.1% assumed rate of return, and we're beating it. We're right on track with all of our projections. There's even a possibility that we may pay off that legacy unfunded liability earlier than is currently projected if we continue to outperform the 7.1%. It's really, there's a lot of good news here. And again, I can't say thank you enough for that extra funding and what has meant turning around this system.
Yeah, and I'm not trying to pour rain on the parade. I constantly look at those numbers that are coming up in a few years, and it always gives me a little pause. So
yes, sir.
I think it's something we should discuss.
I appreciate the question. Yes, sir.
So appreciate it. Thank you very much. Thank you, Mr. Chairman.
Yep. Bo, please proceed.
Okay. Returning to the slide with health insurance trust cash flow, I'll just go over it just like I did with the for the retirement annuity trust. Again, these are preliminary and unaudited. Starting with the second column from the right, at the very top, we say that we have member contributions into the health insurance trust of $217,200,000 for 2024, compared to $212,500,000 for the previous year. Employer contributions from the state, school districts, universities, $232 million in 2024 compared to $208 million in 2023. Recovery income, those are drug rebates and subsidies, federal subsidies. We see we spend a lot of time trying to make sure we're getting all the rebates the health insurance trust is due and all the subsidies that we can acquire. Our staff spend a lot of time doing that. We see that as provided $153,800,000 for 24, up from $145,400,000 for the previous year. Investment income, $50,100,000 in 24, $31,700,000 in 23. Total cash inflows were $653,100,000 or 24, up from $598,400,000 or 23. Benefits paid out and refunds. Again, this is mostly the benefits going out, health insurance benefits, $353,400,000 for 2024, up a little from 2023 when it was $333,600,000. Administrative expense, $2,100,000 in 2024, up very slightly from $2 million in 2023. Total cash outflows, $355,500,000 in 2024, down slightly from 2023 was $335,600,000. Let's see, net cash flow. So we see a positive cash flow for both those years, and we see it's has grown actually, a positive cash flow. And again, because we're getting all these additional contributions in from that historic landmark 2010 share responsibility legislation, where we transitioned from the state voluntarily paying for almost all the cost of retired teachers' health insurance to that being shared with active teachers, retired teachers, and school districts all stepping up in a significant way to pay a lot more towards their health insurance. So as a result of that, that's why we see these strong positive cash flow numbers. $297,600,000 for 24, $262,800,000 for 23. And then, just like on the previous slide, we also see we had investment gains, both realized and unrealized, which is the rest of the story. For 2024, $288,200,000, up from 2023, $211,300,000. And again, just focusing on those two numbers at the bottom in the second column from the right, starting with the top one first, we see that the assets in the health insurance trust at the June 30th, 2023 were $2,743,400,000. That grew by $588 million into the current year, fiscal year period ending June 30th, 2024, to an amount of $331,300,000. So really nice growth there. That's something that I know all our teachers are feeling very reassured about, and thankful for. Next is our asset allocation, and this is for the Retirement Annuity Trust. In the column on the left-hand side, you see the various assets that we are invested in, ranging from U.S. equity, non-U.S. equity, fixed income, real estate, alternative investments, which is private equity, additional categories, which is largely private credit and timberland, and cash equivalents. And then going just to the right of it, you'll see what percentage of our total portfolio was invested in that asset class as of June 30th, 2024. I'll just do the top line row here, and if there's questions about any of the others, I'd be glad to take those. But you see for U.S. equity, we were 40.3% of the total portfolio was in U.S. equity. Our target is 38%, so right on, right at it, and the range is 31 to 48%. So well within the range. You're always going to see fluctuation, with these percentages, because as the value of one asset grows in comparison to the others, it's going to be larger in size and percentage. So you'll see that constantly change. But we want to stay within the range, and I'll tell you that all those asset classes that I just ran through, TRS as of June 30th, 2024, it was within all of those ranges. The next slide is the same information, but for the health insurance trust. And I will just note here that same as with the prior slide for the retirement annuity trust, where we were as of June 30th, 2024, was within the ranges for all these asset classes. So we're staying where we want to be, either right on top of the target, or we're very close to the target, or at least within the range. I believe I just have one more slide here.
Bo, we have
Yes, sir.
to interrupt you for a second.
So
Chairman
it's not my
Johnson.
mission in life to interrupt you all day long, but I do have
Oh, it's fine.
just, and I think we ask this question every year, but just for the record, can you speak to what alternative investments and additional categories involve?
So
That's kind of a nebulous couple of terms. So.
yes, alternative investments is what is called private equity, and it's really the business of business. So you have a general partner, and you have a lot of limited partners. The general partner will be one of these large investment firms that, or everybody's heard of, Carlyle, whomever. And they are the active manager as the general manager. They also bear all the risk of the investment, with the exception of the limited partners have only at risk what they put in, into the investment. But if there's some huge lawsuit or something, the general partner bears all that risk. They are the active manager of that asset, and it can be anything in the world of business, from shipping to buying commercial airliners that are aged, fixing them up, refurbishing them, and then selling them again or leasing them. So it can be a lot of things. It is the business of business. And private equity is largely what makes up the alternative investment space there. The additional categories, timberland, we own with a timberland manager, acreage in the southeast, the northwest, lots of acreage, upper peninsula of Michigan. We have timberland there. And it's just part of diversifying, our investments, and timberland fits a niche for us. And we also have private credit, which can be like private bank loans to businesses.
Very good. Thank you very much. Thank you.
Thank you. Bo, please proceed.
Okay. Whoops, went too far. So this is my last slide for today's presentation, and this is just a recap of the 2024-26 biennial budget. And again, this is great news. Again, I've really like sharing this slide with our members. We go out and talk to our members across the state, and we use this slide always, and emphasize that after many years of not having full funding for the retirement annuity trust, that's turned around. And so that by the end of this current budget biennium that we're in, which we all know ends June 30th, 2026, that will mark 10 straight years of full or very, very, very nearly full funding. And by very nearly full funding, in 2017, we got, I believe, 99% of all the funding we wanted. In 2018, we got 97%. So turned around on cash flow. We got out of the danger, approaching the danger area with the negative cash flow. We're able to invest better. We're able to invest in things we want to. Some things that are not so liquid that we were having to, not invest in before because our funding level and our cash flow issues were bad and getting worse. So great news there. That second bullet point is very important. It's an additional, over the 2 years of the biennium, TRS, and the budget is appropriate more than $1.75 billion in what I'll call additional funding for the Retirement Annuity Trust. We have, as you know, we have fixed statutory rates of funding for the retirement system, which worked sort of for a while, but they became, inadequate, and that's when we needed to have additional funding to come into the retirement system to really pay off this legacy unfunded liability that we had. And this additional funding is what's allowing TRS to implement its funding strategy to pay off that legacy unfunded liability. And we will do that. If this additional funding continues, TRS will pay off that legacy unfunded liability. It will be 100% funded. And at that point, and we have a graph that shows us, and I believe I've showed to this board before, at that point you will see the contributions by the state here in 1 year to the next drop drastically to less than half, to close to almost a third of what they were paying in the previous year. Great news there. So there is a light at the end of the tunnel. It is there, and we will achieve it with the additional funding. We also received $161 million from the state for the state share of the under age 65 health insurance for our retired teachers under that shared responsibility plan I was talking about. So this represents also for both these years full funding for the health insurance trust. So thank you for that. And then additionally, in this budget, TRS was appropriated just an additional $80 million that is being received by the retirement system every month over the 2 years of the biennium. So all this is being put to good work right now, and we certainly appreciate that. And with that, that concludes my presentation. If there's any questions, I'd be more than happy to take them at this time.
Thank you, Bo. Where we're on that, we kind of ended up there with healthcare. While we're on that, I know you've had a good look at the Inflation Reduction Act and what it might do to, or the effect it will have on TRS and your health annuity trust. Can you give us an update on that?
Yeah, so we've been very proactive on this issue. We've spent a lot of time on it, looking into it. We spent a lot of time making sure we understand it correctly. We spent a lot of time seeking guidance from the Centers for Medicare and Medicaid Services and from the IRS. In fact, we're on the phone with them today. And we've been very diligent about that. It is a slow process. I mean, there are a lot of steps involved in trying to get guidance from these federal agencies, and you're in line with other people that they are responding to on various matters. So it just takes some time. We're working on that and hope to get some guidance. I will say that there are we, like I think it's Bo noted, that they have we have a self-funded Medicare Part D, it's called Employer Group Waiver Plan. It's a Medicare Advantage type plan, Employer Group Waiver Plan. You hear the acronym EGWIP all the time. That's what they're talking about. And so we have an EGWIP, and I will let you know that there are 28 systems across the country that have EGWIP plans that are seeking exemptions from some of the applications of the Act. And those exemptions are being sought with the Centers of Medicare and Medicaid Services, CMS is the acronym for that. So we're still waiting on that. Again, it's a slow process. We were preparing for it, and we've had a lot of time discussing it.
Thank you. I did notice, and Chairman Johnson brought up about I was going to ask you about negative cash flow, but I will commend you that it's reduced from last year, so that's a step in the right direction. Could you give us an update on the funding levels of both the health and retirement trust funds?
Yeah, so, as we've presented before, we're at Again, we were trying to pay off this legacy unfunded liability. And the health and retirement insurance trust, they're very different, okay? They're very, because they're being funded differently. But with the retirement annuity trust, as I've noted before, we're still kind of in the earlier part of that amortization period of paying off that legacy unfunded liability. And again, I use this analogy all the time, but in case anybody hadn't heard it, it's akin to paying off a home mortgage over a 30-year period. That's what we're doing. And as everyone knows, the home mortgage, those early years, you're paying off a little bit of principal, but a lot of interest, okay? And it takes a while. It takes several years into that mortgage before you start, principal equals interest, and then you surpass principal payments, surpass interest payments. Same thing with paying off this unfunded liability. So our actuary has projected for years that our funded status for retirement annuity trust is going to grow very slowly. Sometimes it's going to be flat in these years. We have projections going back, several years that show exactly what we're seeing now. And I'm saying that because last year, it's flat from last year to this year for the retirement annuity fund. The funded status 58% basically. Okay, it stayed flat, and it's going to stay pretty flat. Anything can change a little bit, but its trajectory is not going to increase greatly in the next few years. It can be really relatively flat or grow very incrementally. But we have a graph. I know we've showed this board at one time. I probably should show it again. And it shows that in a few years out, when we get around 2030 or just after, you're going to start seeing that funded percentage start growing at a faster rate. Just like with the home mortgage, you start seeing the principal being paid toward the debt grow at a much faster rate. So that's where we are with the funded status for the retirement annuity trust. For the medical insurance trust, again, a different funding mechanism with shared responsibility, positive cash flow. It doesn't have to have positive cash flow, but it has positive cash flow. It's growing very strongly. It was a funded level at the end of fiscal year 2022 of 63.7%. Fiscal year 2023, it had grown to 71.3%. So very strong growth there. I will add a caveat here. We will continue to see this strong growth as long as medical inflation remains doesn't have to be exactly the same, but kind of within bounds as we've seen since 2010. Federal subsidies continue to be available as they have since 2010. Rebates, our ability to take advantage of rebates continues. And we don't have any new federal legislation that imposes additional cost, So we have something, with the IRA that we're looking into, but most of those things have stayed pretty constant. So really good news there on the health insurance trust. That was landmark legislation in 2010, and I know there were some people on this board who were there in 2010 who were supportive of that. So great news. Great news for our teachers.
Okay. Thank you very much. Gary, I don't want you to feel like you've been left out.
I feel left out. So.
Okay, well, I have a question for you if you don't mind. Always listen to your address to the retired teachers every year, and it's always very positive. 2 years ago, you made a comment to them that the retirement plan is in good shape, financially sound, and will continue to be as long as the General Assembly continues to make their required actuarial contributions. This year was each year was close to $1 billion. Next budget cycle, we will hit $1 billion in each year, and not too far out into the future, it looks like those payments will go to $2 billion a year. I have some concern about that. That's we've 10 years straight we've paid that every year. But I just your comments on that, and I know that hopefully this General Assembly will continue to make those full actuarially required contributions. $2 billion is a heavy lift.
It is, Senator. There's no question. And but I will tell you that the teachers I just met with a group of about 150 retirees last Friday. Gave them pretty much the same presentation, not as smoothly as Bo gave, but gave them pretty much the same presentation, did show them this slide. And they are extremely appreciative. And if there's one thing that an active teacher appreciates, it's their pension. Knowing they're going to have that after their years of teaching and things. And so what you're doing here doesn't go unnoticed at all by the teachers. And what the legislature has done here is historic. The thing also that the legislature has done by passing our TRS, what we call the TRS 4 tier, is when that tier takes over and this old legacy liability is paid off, the state's going to have no more unfunded liabilities with teachers' pensions. No more unfunded liabilities. And the other thing, as Bo has mentioned numerous times in this presentation, is the legislation where we pre-funded the retiree health care and we set it up right. We got enough contributions coming in to get a jump on that, to get ahead of retirement inflation, and to get some assets built up in that trust where actually the assets could start paying a lot of that cost as opposed to the taxpayers. And we have saved the taxpayers over $5 billion by that legislation that you passed, because we've got the money now that the assets are growing to pay the debt as opposed to taxpayers having to come and pay that debt. And teachers have contributed a lot to that. They went from 0.75% of pay to 3.75% of pay, and their school districts matched that 3% increase with 3% out of their budgets that come into this plan. So it was a well-funded plan, a well-thought-out plan, and I applaud you for passing that plan and taking care of their health care too.
Thank you. And when you speak, people listen and they believe what you're saying. So I got two questions for you that that we get asked all the time, and I don't think they believe us. But the new Tier 4
Yes,
is a defined benefit plan.
it is. It's got a supplemental component, but the majority of the plan is designed as a defined benefit plan. And in many respects, it's better than the tiers that came before it, because now individuals can contribute more to the plan if they want into the supplemental component. It's an extremely good plan, very good plan.
Well, thank you for that. Another thing that we did back in 2010 when we did this shared responsibility, the General Assembly had borrowed $800 million from teachers' retirement.
Yes.
I hear constantly that we've borrowed money and not repaid that. Could you, for the record, tell folks that are listening today that the Kentucky General Assembly bonded $800 million and repaid what they owed the teachers' retirement system when this shared responsibility started back in 2010?
Not only did the General Assembly bond that $800 million and pay the retirement system back, and if Ryan Barrow could come up, he helped us sell those bonds, those $800 million in bonds, and they've been paid back since. But the great news is that we borrowed that money very, very cheaply. And you can see our 10-year returns was well above the 2.5% roughly that we paid on those bonds. So we had it was a great benefit for both the retirement system and then that, coupled with passing the shared responsibility legislation, put this teacher's pension plan in the best shape it's been in since I've been associated with it in 1975.
Yeah, thank you. And one of those other things that we tend to forget, I think it was 2008, the stock markets took a big hit.
A little, yes.
And we owed you $800 million that didn't get hurt.
At the same time, that's right.
So it was good that we had it and it wasn't exposed to the market.
That was good timing.
One final question, and like I said, I listened to your address to the retired teachers this year, and you talked about the healthcare trust, health insurance trust, and that as little as 5 years we can start to unwind that.
Yes.
And you also said that there was a plan in the legislature and a plan in statute how that would come about. So
right.
Would you explain to me or to the group here today your thoughts on the unwind?
When the legislation passed, the superintendents came together as a group and stepped up and agreed to take 3% out of their budgets. But they did so with the understanding that when we reached a comfortable level of funding, somewhere around 100%, that we would start reducing that 3% that the superintendents put in and the additional 3% that the teachers put in. And the plan then was, after their negotiations with the legislature during that period of time, the plan was that those contributions would start coming down until they matched what the state's putting in, and then all three contributions to the medical trust could come down equally. So it was a shared plan going up, and it would be a shared plan coming back down, and backing away from those high contribution rates that we had in order to get that plan off the ground and launched.
Well, thank you for that, and hopefully we can have some conversations and not wait till the 11th hour when that comes about. That we have a plan that a lot of water's passed under the bridge since all that conversation went on. We need to rehash that and talk about it and have that ready to go. Representative Tipton has a question.
Thank you, Mr. Chair. If you'll bear with me, I have more than one.
We will bear with you.
Whoever's feeling left out's welcome to answer as I ask. And a lot of it's been touched on, and part of it's the tier four plan, and the Teachers Retirement Board was given several levers they could pull if that system got below a certain percentage. We're only 2.5 years in to that system. Do we have a percentage funding level on that? Do we have a breakdown on what that? Can we keep up with what that percentage funding level is? I think you understand what I'm asking.
Yes,
So
sir.
that we can monitor that and be aware of what's going on there.
We do every year. We have the actuary look at that on an annual basis to make sure it's above those levels.
I believe is it 90%?
Right, 90%.
That 90% level.
If it falls below 90%, then the board needs to pull a lever to make that.
Is that information you all could share with us here at PBLB just so we know what that ratio is?
Absolutely.
So we can stay comfortable too.
Yes.
Okay, thank you, Gary. We talked a lot about the healthcare funding. You just alluded to the when the time comes, we get around 100% having it paid on that healthcare. As has been testified before, do you all anticipate, due to the Inflation Reduction Act, a potential increased cost to the system that might delay the time frame on that from happening?
It's possible that it could delay it. I don't think it's going to hit us as hard as it's hitting perhaps KPPA and judicial forms. We're estimating about $20 million a year additional expense as a result of lowering the out-of-pocket from $8,000 to $2,000. Most of our teachers don't get close to an $8,000 out-of-pocket copay on their prescription drugs. So this is going to impact just a small percentage of our retirees over age 65. That's why we're looking at a low number, like around $20 million a year additional cost.
And Mr. Chairman, I have one more question.
Please proceed.
As I'm looking at the employer contributions in the trust and in the medical, I total those up for fiscal year 24. It's about $1.4 billion total combined in that. Now, also, could you break down for us how much of that is the statutory required contribution that is contributed at payroll time, and how much of that is the portion to fund the unfunded liability? Can we have a breakdown on what those numbers are?
I've got, let's see, that for
I'm thinking it's around $450 million for the statutory required.
That's close.
yeah, that is correct. That's I've got $460 million for fiscal year 25 and $470 million for fiscal
So we're
year
just
26.
a little shy of $1 billion on the what's being paid toward the unfunded liability. That number's going, as the senator mentioned, that number's going to continue to grow till we get to, I believe the year right now we're looking for is 2047.
Yeah.
When we drop the bottom drops, I won't be here then, but I hope the General Assembly has fun appropriating that money or cutting taxes. Thank you all.
Senator Berg, you have a question?
I do, Mr. Chairman, and thank you for the presentation. Okay, so there's no such thing as a stupid question. From what I'm understanding, we're funding the unfunded liability at 2.5%. Is that correct? Is that what somebody just said?
The unfunded liability is the unfunded liability for the retirement system is about 42%.
No, but what are we paying on interest on that?
Gary, if you will, pull your mic closer to you, Mr. Harbin.
I'm sorry.
That's okay.
And I'm going to let Bo answer the question because he has the numbers before him.
Okay, thank you.
So we have a $17.5 billion unfunded liability for retirement annuity trust, and you are paying towards that. It's for fiscal year 25. And some of the fixed amount, the fixed statutory amount, and that can be 13.105% of payroll the state pays for our individuals who became members before July 1st, 2008. It's 14.105% the state pays for individuals who became members on or after July 1st, 2008. And then January 1st, 2022, it's 13.75% that they are paying both pension and health insurance, okay? So, for example, that 13.105% I gave, all but 0.75% of that's for the retirement annuity trust. That's more than we need for the normal cost, okay, of the plan. You know, if we didn't have an unfunded liability, we wouldn't need that 13.105%. We would need 0.75%, but we wouldn't need the rest of it. So in addition to that amount, $769 million in fiscal year 2025 is needed to go towards implementing our plan to pay off this legacy unfunded liability, and $953 million for fiscal year 26.
So my question actually, sir, going back to the mortgage analogy, how much interest are we paying versus how much principal are we paying? And is there any way with the additional funds that we're having to pay off that principal early? That's what I want to know.
Well, and that mortgage example is sort of akin to explain. It's not, exactly apples to apples, but it's kind of, that's the way it works. You're paying off, less of that unfunded liability and more on mortgage, on the interest. But anyway, more money that comes into it, like the $80 million that was, we're very thankful for being provided in the 2024 budget for the next 2 years. That helps. Having that money now to invest now and earn over the long term, we think at least 7.1%. We think our actuary is a little conservative with the 7.1%. We can maybe do better, but even at 7.1%, the compounding effect of that is tremendous. And just like putting retirement savings in a 401k earlier rather than later, the effect of that is significant.
A follow-up question, please. So you're telling me you think it is financially more feasible for the state to take that $80 million and invest it rather than using it to pay off the principal that we're paying interest on, because we're able to make more money on the investments than the interest rate, but I don't even know what we're paying on this.
Okay, well, I will say that, we are investing that money, so it is advantageous for the pension plan to have that money early. But where the budget allocations are certainly, a policy decision, policy matter for the Commonwealth. We make our standard budget requests every year that the actuaries recommend to us that we need to, one, pay our normal cost, and two, implement our funded plan to pay off the legacy and funded liability. And we're happy with that. We're very appreciative of receiving that. But when we do receive extra money, it does, we invest it, we put it to work, and it does grow with compounded interest.
At a rate that is higher than the interest we are paying on what we owe.
Yes.
Unequivocally. I mean, that's the question. If it's not, then we're doing it wrong.
We've earned 8.1% over a 30-year period, and the liability is based on 7.1%.
7.1 versus 8.1. And you're talking over a 30-year period, but I don't have 30-year numbers from you. I have 30-year numbers from the other plans. Where are the 30-year numbers?
We had that in our slide on.
No, you go out to 20.
It's in the blue box at the bottom. I probably didn't point that out where it was, but at the very bottom.
The 30-year, yeah. I see that. So this is, okay. And this is a compounded gross return.
Right.
Yes.
And you're
Yeah.
compounded at 8%.
All right, thank you. So 7.1 versus 8.1 is what you're telling me over a 30-year period.
Yes.
You think you're making a 1% margin?
That's not the way it's actually calculated, but the liabilities are calculated, discounted. The actuary will take every member we have, all 144,000, and they will project out for each one of those lives, based on their salaries, how much they're going to get or earn based on the state formula for their pension when they retire. They'll take that huge number and then they'll discount it back to today's numbers
Right.
at 7.1%. So that creates a liability that they expect to grow at 7.1% annually. And we've earned, if we had all that money there, we would outperform that. Our assets would grow by 1% more than the liabilities every year. But that's what we're doing now, is we're paying off that unfunded liability, the difference between the assets that we have now and the total liability that the actuaries calculated. We're paying that off now. That's what Senator Higdon and Representative Johnson were talking about. Was
But
the
rather
additional-
slowly. I mean, we have a long
We have a lo-
trajectory.
Right.
The state is paying interest on that money, correct?
Well, the liability grows, but that's 7.1%.
Right.
Yes.
Okay, thanks.
Yes. Good question.
Seeing no further questions, Bo, thank you for being here today. Gary, you don't need a special invitation to come
Thank
back.
you, sir.
Okay.
Thank
You're
you.
welcome anytime. Our next meeting is September the 24th. And I guess at this time we entertain a motion to adjourn. So moved. Okay. So moved.